Hello and welcome to another article in real estate, and today we're going to be talking about, this is interesting. The Trump administration is actively evaluating portable mortgages. What you need to know. What is it that we need to know? We need to know, well, this is interesting because if you have a mortgage with one house that you bought, you could pick that mortgage and put it into a new property that you're buying. You could transfer it, you can move it over, so you can keep that low interest rate if you have one of 2.5–3%, which a lot of people do. So they get into this article though. The Trump administration has another idea to make housing more affordable. Let homeowners take their mortgage rate with them when they move. Interesting. So on Wednesday, Federal Housing Finance Agency Director Bill Pulte said the administration is actively evaluating so-called portable mortgages. The proposal aims to address the housing market's lack of supply. Interesting. I know in some areas we have too much supply. We have too much on the market. But that's local to the area, correct? So to go further into this article, just over half, and look at this, this is interesting. Just over half of homeowners with a mortgage have a rate below 4%, according to the Redfin analysis of FHFA data. However, the average rates have remained stubbornly stuck between 6 and 7% for the last few years, and that's true. So, again, it's a good idea. I think this is a good thing that you have a low interest rate, and, people don't want to move because they have these low interest rates, and they would pay a lot more with a new home at the average of 6.5–7%, which is right now. So moving that mortgage, you're saving so much money. I think it's a good thing. How do portable mortgages work? A portable mortgage, allows a borrower to transfer their existing mortgage and mortgage rate to a new property when they move instead of taking out a brand new loan. You're kind of resetting the whole thing. Oops, let me go back here. Anyways, so here's an example. For instance, imagine a homeowner selling their home for $400,000 with half of that paid off on a 3% mortgage. With a portable mortgage, they could sell their home and transfer the $200,000 left on the loan to the new home, keeping the 3% interest. Interesting, very interesting. Now things get trickier, Things get trickier. If the new home is more expensive, if the cost is $450,000, for example, the buyer would need to cover the extra $50,000 either in cash or through a second, smaller loan likely issued at the current higher interest rate. So yeah, you still would have to get a loan or get some cash if the house is higher, but you're still saving money. You still have that savings. So you're not saving as much, but you're still saving, which is important. So might this backfire? Well, portable mortgages can disrupt the engine powering the U.S. housing market. Mortgage-backed securities. These are essentially bundles of mortgages the banks or lenders sell to investors, which give the banks the cash they need to issue new loans and keep the mortgage market flowing and flowing and flowing. So that's the backfire, but for everyone else, I think it's great. We pay a lot in taxes, we pay a lot in upkeep, and this is just one way of helping buyers save and sellers being able to buy a house. It works both ways indirectly. So thank you again for watching, listening, tuning in. Give a thumbs up. They're free. Real estate is expensive, will be, and sometimes it's reasonable, depending. Have a great day. Take care.